What's going on, everybody? Very excited to have you here with us as guests on today's webinar. I'm going to welcome in Michael, Sean, and Wayne to our discussion. For any of you who have been on these before, these are informative. They are unscripted. That's the beauty of this. We're going to tell you the story of why Michael got involved in the business. But before we get there, Wayne, I'd like for you to give kind of the general update on where are things at, and that will guide us into Michael's story. So Wayne, how are things going? What's the updates with IWG?
Thanks, Nick, and welcome, Michael. Welcome, Sean. Great, and welcome to all of our potential partners and colleagues here on this call today. Really wonderful being with you. Take a look back here as we get ready to close out July of 2023. I have to say, Nick, I think it continues to be remarkable in how the industry and just commercial real estate in general continues to shift. We launched our next phase growth strategy roughly about 16 months ago, and for many of you on this call, you'll be quite aware. Currently, International Workplace Group, we operate over 4,000 locations globally, of which 1,200 of those locations, Regus, HQ, Spaces, Signature, are currently open and operational, have been for the last 30 years here in North America. Very, very broad network, and it expands across 550 cities. And what's interesting is we've been growing for the last 30 years, just trying to keep up with the demand as the thought and idea and need for office space continues to evolve. And in the 9 years that I've been with the organization, we are at a stage right now where it is extraordinarily dynamic. A few things are taking place. Number one, in North America, and also really in many parts of the world, but let's talk North America, we've hit record levels of office vacancy. The US has now surpassed 17% in office vacancy throughout the country. But what's interesting about that is, not every city and market is the same. Many cities that were flagship cities for the last decade have now accelerated past 30% in office vacancy. That's posted vacancy. That doesn't include shadow vacancy, of which shadow vacancies space that's basically been given up by an organization because they've shifted towards a hybrid or a remote working model, where they've just realized that space doesn't meet their function any longer, but yet it's still under a lease. So just posted vacancy for the country is now 17%, 30% in many major markets, and growing. Canada, no different. Canada's now hit 17.8%. Just to give everybody a quick synopsis, those are both record level vacancy rates. And in 2019, both in the US and in Canada, we hit really record level lows in vacancy or occupancy rates. In 2019, Canada was roughly 5.9%, and the US was roughly about 7 to 7.5%. So you can see how the numbers have dramatically shifted in the last 3 years. And one of the really interesting studies that has just come out, which I greatly valued, primarily because it wasn't a study underpinned by institutional developers, nor the real estate industry, nor flex space providers like IWG. It was a study that was conducted by McKinsey, obviously global leading consulting firm, and they were really looking at the state of the commercial real estate industry and the office industry, but I think more critically the state of cities as we continue to move forward. And a couple of elements that they talked about. And by the way, for everybody that's out on this call, drop me a note. I'll share with you the study. I think it's a really interesting insight into what the future may hold for this very specific office commercial real estate industry, and also how cities in general are completely shifting. And we're really moving towards this economic shift into a more localized environment. The 15-minute city is becoming more and more of a reality today as people want to and are living, working, and accessing the restaurants, the cafes, the services, all the elements that they look for in their day-to-day are now continuing to move towards this 15-minute city concept. And one of the elements that McKinsey had assessed was best case scenario for the office industry is it will take another 10 years to be able to just stabilize vacancy rates. And that's the best case scenario. Now, I'm sharing with you these facts, but with that, I think is tremendous opportunity, because the reality is it's a misnomer that people want to work from home every day. People want choice and ubiquity in where they choose to work and live. And frankly, in North America specifically, they want to eliminate the commute. And with that, it's shifting how investors and how operators are looking at office space. And they're actually starting to take a different approach to ask, how do I best position my building or my development or the space itself to meet the changing needs of the tenant or the occupier, which, by the way, may not necessarily be a single occupier any longer. So with that, the market is shifting. And where there's times of distress, there's times of tremendous opportunity. And I'll give you one point. In the last 16 months, in moving towards more of a partnership growth model, because we recognize the need to continue to add more and more flexible workspace locations because clients are demanding it. In that short period of time, we've now signed 700 partnership agreements around the world in 16 months, 400 of those here in North America. And I think what inspires me the most is to see those locations open up with success, great success, in markets that we would have expected and in markets that are new emerging markets. I mean, we have Michael on the call today who's going to share his story with Columbus, Ohio, like an amazing market that actually, from a flexible workspace perspective, has a higher level absorption rate in relationship to the commercial real estate market than other markets. And yet we're driving success because of Michael's effort and Michael's investment in bringing brilliant space online. We're seeing great success in markets like the Bronx, in markets like Santa Ana, California, like markets like Lubbock, Texas, Dallas, Fort Worth, Houston, places like Truro, Nova Scotia, small towns, 14,000 people. We've opened up a new location and it's been tremendously successful. Why? Because people want great places to gather professionally and socially close to where they live, and they want choice. And it's now being proven in the model. So it inspires me to continue to see that. So we're seeing a real tremendous shift in growth in working with partners like Michael in activating, designing, supporting the construction, and activating, opening, and managing new IWG locations across North America and around the world. And it excites our clients because our clients, 10 million strong, are constantly looking for the next location to support their team members' needs. Right? This is a complete. It's kind of a complete element around the ecosystem of supply and demand. And we see the opportunity, frankly, to continue to grow to 10,000 locations because people want access close to where they need to be every single day. And you're seeing this is we're moving away from this traditional just hub model to hub and spoke model to almost becoming a complete spoke model where space is becoming fluid and dynamic and people want that opportunity to gather. So it's been fairly, it's been really exciting. We're now 700 locations signed with large numbers starting to open, driving great success, and the demand continues to increase.
Thanks for that, Wayne. Sean, I want to go over to you. Before we got on this discussion, I went back and actually listened to the webinar that Wayne and I did at the beginning of this journey about a year ago. And Wayne talked about where the future was going. And there are plenty of leaders who talk about this is what we're going to accomplish. And it's interesting to now see it actually coming to fruition. Like the vision is actually playing through. So from your seat, as you've had conversations with people like Michael or other folks that are sitting on this discussion, how has the discussion changed or evolved from maybe a little more apprehensive a year ago to now, I better get on the bus faster? How have you seen the shifts change in the conversation that you're having?
It's interesting, and I appreciate you having us on, Nick. And it's interesting because I was thinking about when Michael and I first met. He was one of the first landlords who mentioned that he was already seeing some demand for individual offices or more flexible terms, and it was kind of a road that he's like, I don't want to venture down this by myself. I'm doing all these other things, and when I first heard that, I thought, he gets it, and this is going to be this will be a great conversation. We can at least understand each other. Fast forward 10 months later, and that's almost every conversation I have. And most of the landlords I talk to, and it not just in one centralized area, but in different states and different areas, I hear the same thing. They're getting multiple calls a week or a month for folks who just need a smaller space or more flexible terms. They prefer to focus on what their main business is, right? Development or construction or whatever their main business is. They're looking for a solution. And really our approach hasn't changed in the last 16 months. It's the same. This is what we're offering. I think it's the insight that a lot of building owners have into that change and the direct shift, not necessarily the shift away from larger space, but the shift from larger space to individual, more flexible offering in one or more multiple assets that they have. And as I mentioned, the conversation that Michael and I had, he was already, for the past few years, he was already redeveloping this beautiful corner of downtown Columbus into something that, as Wayne mentioned, the 15-minute city. It really kind of the missing piece was, do we have something to offer the person who makes a phone call and says, I need an office, and within 24 hours we're setting up a tour and signing them up to come and have a place to work every day. And so far it's been great. We're 3.5 weeks open, and we're starting to see some early success. So his vision a few years ago and what we're doing was certainly we hit the mark.
Love it. Appreciate that. Michael, I want to go to you with a twofold question. And the reason I'm asking the second fold to that is because we talked before we jumped on here. And so I want you to start with your Regus story, because you were telling us about you were actually a customer long before you even got into being a landlord. And then take us through the journey of what were you feeling as you start having these discussions and how you actually found IWG as a solution for what you were looking for. Give us a little bit into your complete holistic journey with Regus and IWG.
Sure. It's a good question. I'm familiar with the Regus brand and IWG from way back. Back in 2016, 2017, we had a small financial technology startup in Chicago, and we were just looking for a little bit of space, just a space where we could meet, work, take our calls from. And we had 4 people in one good sized office in the John Hancock building, and I had an appreciation for what Regus was, because at that size, we weren't ready to make a plan for what our 5-year real estate needs were going to be. We just had an immediate need, and working with Regus was a great way to work with that. We expanded in that space. Eventually, grew the company to have 100 desks and half a floor down the street. But Regus was a really good way for us to scale in a really rapid phase of growth. So, since we sold that company, I've been focused on real estate development. And so when Sean reached out to talk to us about our location here at Broad High in Columbus, I was already familiar with the model. And like you said, it was solving a number of problems that we've been hearing. A lot of our office leasing is that conventional lease. It's 5 to 7 years. It's TI. The tenant might have a right of first refusal on some additional space, but they're pretty well boxed in. And post 2020, we've just been hearing different things from tenants. They want to do different things. They want to accomplish different things, whether it's they need a presence downtown, but they also have an office they're working from in the suburbs, whether their team's a little bit more distributed, whether it's key that they even have meeting rooms. For example, one of the tenants in our building, who's there on a long-term lease, they want to book a Regus room just to have an extra conference room. They don't want to change their lease. They don't want to amend it. They don't want to expand, but they need that conference room, and they're willing to pay for that flexibility, And you just hear enough of these different things where people are really talking about one thing. They're talking about flexibility and the ability to have space that they can use today to meet their needs, and they know that their needs might be different in a year or 2 years. And talking with Sean, it just seemed like this was a great way to do it. Again, it was a fast process. We got the project management team involved at the beginning of this year, and just opened the center a couple of weeks ago, and it's off to a great start.
Yeah, I really appreciate that opening, Michael. And I have a follow-up for you. For anybody that's watching, feel free to use the comment feature on whatever platform you are watching this on, and we'll make sure the questions get addressed as we continue the conversation on. Michael, as you were going through the sales process, you get the call from Sean. Two questions. One, did you have an understanding that this was actually a business opportunity? You knew what Regus was, but did you know it was a business opportunity? Is it related, or was that the first introduction to this as this could be a potential solution for my building?
Well, it was. I had the idea, but I had kind of, I think, an outmoded idea. I thought the deal that we'd probably structure, the one that we originally talked about was a little bit different than the one that we ended up doing. They were talking about half a floor that would have been 4,000 or 5,000 square feet, retrofit of an existing space. I assumed it would be on kind of the lease model that used to be popular. And then when Sean and I met, we started talking a little bit more about what does partnership look like and how do you drive value in a partnership, work through some of the pro formas. And we're talking about demand in downtown Columbus. And ultimately what we decided on was building out the entire second floor across a few buildings as one contiguous space that would really, we get to leverage some of, the IWG team's experience in terms of structuring the right build outs, structuring the right kind of sellable space. That's one thing that I really liked about, because I was familiar with the business opportunity. We talked to probably 3 or 4 different, groups that will advertise flexible or co-working space. And some of them are local, some of them are regional, some of them are national. And we talked with them, and frankly, we've seen other ones come to this market and not do well. But when I talked with Sean, again, they were getting very, very quantitative about what individual offices would sell for. If you move this wall, this is how much bigger this space is. This is how we price this. And again, the thing that I think was most striking to me was just, the data that IWG was working with. They really, really know this market. In office, sometimes I think you do things that are a little bit speculative. You build out a suite in anticipation of a tenant's needs. You have an idea of who that user is going to be. Maybe you have to add offices. Maybe you have to change a break room around. But working with Sean made me really feel like this partnership for the Regus space was going to be data-driven and informed by how people are working today. And that gave me a lot of peace of mind, because it was a big investment. It was a big investment in the space. It was a build out that's different than what we've done historically in terms of the density of offices. But at the end of the day, it was just a much more convincing pitch than anyone else we talked to in the flexible work space. Some of whom had, they sell the sizzle, but they can't talk about the kind of track record that IWG has.
With about 200 people watching live and more watching this beyond it, I would imagine the reason someone sits on the sideline is there's some sort of hurdle that they have to overcome. Now, obviously, you've not only gone through the process of signing, but now you've gone through the process of opening. Are there any hurdles that mentally you had to overcome, and how did you overcome them to eventually get to yes with IWG?
Yeah, I mean, it does require a little bit of a paradigm shift, right? There's a level of comfort that you have when you go into a deal with an office tenant, and you can say, from year 1 through year 10, I know what I'll be paid each month. And the IWG partnership offers a lot of upside on the revenue share model. It looks a lot better than our conventional lease on the pro forma, and we're tracking ahead of our pro forma. But to me, it was really about getting comfort that there was going to be an ROI there. Like I said, the build out was unique. Some of the build outs that we do are really lightweight. There are a lot of open workstations. Those are for when we're building out for office tenants. This was, again, 10,000 square feet. I think we put about 70 hard wall offices in, which is an incredible density. That actually made for a kind of fun project for our architect and GC, who really work almost exclusively on office and medical office. So it was a higher density build out than we've ever done before. But yeah, I mean, it takes some work to get conviction that you're going to do something different here than you've done in the past. You're going to make an investment, and there's going to be this payoff. But again, that's why I probably asked Sean, I probably exhausted him with my questions, asking him all about the different things that go into this space. And the other thing I would say is the thing that gave me a little bit of confidence is that this is controllable, right? It's different than, for a lot of people I see who develop office, you get your anchor tenant, you get your building filled up, and then you kind of think of yourself as done with the project until the next lease rolls around and hopefully everybody re-ups and the project just continues to run. What I like about this model is that you have an opportunity to go out there and win a little bit more every day, right? We are talking about what office users want. So again, right now in this same building where we just opened the Regus Center, we just finished the TI, and that's not usually when you're reinvesting in your common areas, but we're saying, hey, our bet is if we keep investing in the amenities, we keep investing in the retail, we're going to be able to drive prices here, and we're going to be able to month after month, quarter after quarter, stay ahead of our pro forma. And again, a lot of people who are in the office industry have had some bad surprises over the past couple of years, but this is an opportunity to outperform and actually have some surprises to the good if you do a really good job building out your space, making it a place that people want to be. And again, I like that it's controllable, and that's part of what gave me comfort in this partnership.
Wayne, one of the beauties of a conversation like this is obviously you have everybody that's watching in real time that gets to interact with this and ask direct questions, both to the people that they're working with at IWG and within a channel like this. But beyond this, it's for ghosts, people that are thinking about this, have never given you their name, and are just looking around the internet to try to get comfortable with this idea. So you just heard some of the obstacles that Michael had to overcome. What do you want to say to the ghosts or to the candidates that are sitting on the sidelines to help them understand why now is the right time to get over that hurdle?
Mm-hmm. Look, I think there's a few things, and I can think of a long checklist of elements to share. But honestly, I would start with have an open mind. I deeply value and appreciate. I talk to partners every day, either potential partners or new partners, and people like Michael. And I have a tremendous amount of sensitivity around the fact that every one of our partners, they're business owners. They've made a dedicated investment, whether it's in one building or multiple businesses or portfolio buildings. 70% of our partners, like Michael, own a portfolio of buildings. And some of them are mostly aligned in, some of them may be all commercial real estate, some of them may have a combination of multi-res and industrial and office, but they've identified, and this may be one of multiple businesses. And what I constantly, what I would recommend is look at this, really take a look at each one of your assets. What's taking place today in the market in relationship to your asset, and really try to understand and uncover beyond the headlines what's taking place in the industry. This industry and the commercial real estate industry specifically is going through the greatest fundamental shift that it's ever seen. And this is not a cycle. This is because people are living and working differently, and there are enablers like technology, which is allowing people to become more untethered. And this is a good thing, right? So it gives people choice. It gives people optionality. It gives companies the opportunity to start to expand their talent pool, where they're not just hiring their talent from a place like Columbus, Ohio. They're now taking a look across state, across country, sometimes around the world, to build their organizations. Right? And the workspace is critical to an organization. The great thing is it doesn't need to be one centric workspace anymore. So my recommendation to start with is have an open mind. Think about your investment. Think about what you want to do with that investment. And frankly, speak to somebody who can give you a good assessment, a knowledgeable approach to what's happening in the industry, what's happening with your overall investment, and then what your options are. IWG may be a great option. There may be other options out there as well. What I care about is that each of our partners have the ability to make the best investment for their portfolio, and that they're prepared for not just the future, but the current state. What's happening today is this industry, commercial real estate, is looking more like a hotel industry than we've ever seen.
Yeah.
Right? People want to use space in a dynamic way, and space is becoming a destination. And by destination, the answer is not designing 5,000 square foot spec suites, laying them out with full furnishing, providing lengthy free rent, as well as significant TIs to help underpin and drive a lease. There is a subset now today of our enterprise clients where the large percentage of enterprise clients are rationalizing the real estate portfolio. And we say enterprise clients, it's really becoming across all sector of clients, but we see it strategically with enterprise clients because they're looking to give their employee base, their team member base, the ability to work in a more dynamic way, to access space in a very fluid fashion. And then also, it helps them release capital and liability away from the balance sheet, right? So this is all taking place today. And if you take a look over the next couple of years, there are $2.5 to $3 trillion of debt maturities that are coming up over the next 3 years. We are going to see a tremendous shift in this commercial real estate industry. So what I would recommend is take a step away from the headlines, because the headlines, they drive a lot of sensationalism. We see these large swaths of space that are being given up. We see these big shifts. Look, it's really all narrative. What you have to ask is, I need to align myself with the right people who can show me what are the what are the demand elements, what are the financials, and what can I do for my space? And by the way, it doesn't need to be a full building. Michael's a perfect example, right? And I want to make just really clear for everybody on the call. Michael took shell space and built this shell space out, 10,000 square feet, correct, Michael?
Yeah.
Your 10,000 square feet, what percentage of your overall portfolio does that represent?
In this building, it was actually about a quarter of the building and about 8% of what we have on this block, total redevelopment.
Perfect example, right? 25% of the building, 8% of the portfolio. That's fantastic. That's a perfect opportunity to continue to build, because what's great is we've now added a new brand, a new style, a new location, and a new opportunity to offer up to our members. This is very, very similar to, for example, the Marriott Bonvoy model. What our clients are looking for is design, location, amenities, productive space at various levels of price point, right? So my recommendation is start by understanding your options in a very open, pragmatic way. Speak to experts who can provide, and then it gives people an opportunity to make a great, knowledgeable decision, because of course there's invested capital. The great thing though is that we have a 30-year track record. We can demonstrate from our own capital investment over 30 years that we drive a return based on the demand principles of flex space, and then also our business model. And we're now at that place where, for us, this is a mutually beneficial partnership. Our clients are looking for more and more locations because they want to give their team members and their clients accessibility. We can't grow fast enough in order to meet the demand, because let's remember, today, flex space is representing roughly 3% of the overall commercial real estate portfolio. It's slated to grow to 30% in the next 8 years. In order to get there, right? We need a great opportunity to partner together. And frankly, in order to do so, we want to ensure that every partner like Michael has an opportunity to see great returns on their investment, because it helps us achieve that goal. So I think it's starting with great knowledge and understanding what your next steps are, so you have good options.
Sean, in the sales process, and you've been obviously involved in this for quite some time, have you seen a shift away from having to sell this to now just more educational, answering questions because of how much success you guys have had early on?
Yeah, absolutely. Yeah, that shift happened within probably the first 2 or 3 months, in realizing that I wasn't introducing most of the people that I meet. I wasn't introducing them to co-working or the idea of what we do, or what this, the role this industry plays. It was more of, as Wayne mentioned, just have an open mind, and let me walk you through this, and then we can talk about whether it's a fit or it's not. The reality is it's not a fit for everyone, obviously, but it is a great solution, especially those who have ever considered doing this themselves. And on the surface, it sounds easy, right? I'll build out 15 offices, I'll put those up for rent, I'll lease them out. But then, the expectation's a little different when it comes to, I'm 10 o'clock at night, I decide I want to see this office tomorrow, and I need your agreement to be streamlined and easy to understand so I can get that signed. And I want to move in, maybe within 36 hours of inquiring. And then the inventory management and the billing, and there's a lot that goes into it to run any location. To be a leader, you have to go a step beyond that and deploy local sales team and local marketing and really understand the market. A lot of the folks I deal with, no one understands, their markets better than they do. Michael, for example, few people understand what's going on with commercial real estate in downtown better than what Michael does. I certainly don't. So to partner with him, and then he can have a direct line to us to say, I'm gonna put this branding on the west side of the building because of the foot traffic, and which is what he actually did, and it's been a fantastic partnership. And it really is about, I'm not trying to sell you anything. I just want to have a conversation with you, and if after that conversation you're not interested, we can still be friends. But I think you may be intrigued enough that we could probably dive a little bit deeper.
Sean, one thing you said that I want to dial a little bit more into is you said this is not the right fit for everyone. But I would imagine that statement early on shifted from this is not the right fit for me to it was not the right fit for me then to now maybe we should talk. Have you seen that change of narrative happen?
Personally, I've seen that 3 times in the last 12 months where, about this time last year, 14, 15 months ago, it was, I'm not interested. I don't want anything to do with it. And then, the phone rings one day and, do you remember me? Let's pick this back up, and happy to have those conversations as well.
Yeah, I love that. We have a whole bunch of questions that are coming through, so I want to start addressing these, and we'll get back into it. Webb said, Michael, what kind of return are you seeing compared to traditional leasing?
Yeah, so that's all based on our pro forma, and our centers. We opened our center the first week of July. We're tracking ahead of the pro forma. The pro forma has, by the end of the first year, we should be actually about a third ahead of where we would be with a conventional lease if we took this space out to market today and got the tenant that we wanted. And by year 3, even further ahead. So actually about 2/3 higher than we'd be on a conventional lease. I mean, again, we invested in the space, so it's more TI than we would have had, but that's kind of we went all in on the upside of this, right? The one thing that I like from the IWG team is they tell you, it's your center. We'll provide you all the information. We'll provide you all the design specs, but it's your center. So we had a lot of tough questions in the build out. Should we do this value engineering here, or should we stick with the IWG spec? Should we, change these things, or should we really stick with what the project team recommends? And I figured if we're making a bet on Regus, we should really go with their knowledge. So we invested heavily in it. And again, I actually think what's really impressive is 10,000 square foot space. If we were trying to list it today, probably be 5 to 7 year lease. We'd probably give them 5, 6, 7 months of abatement. And if we keep doing what we've been doing over the past several weeks, by month 6, our revenues will be more than they would be on a monthly basis with a conventional lease. And we'd still be short of, full occupancy, and we'd still be on our introductory pricing. So there's room to run, which is, again, why we want to keep investing in the building and in the block, because the better we do as a building, the more our clients like this, the more revenue we're going to do from this Regus Center, which, is not true for all our conventional office leases. Whether we do a great job or a poor job on a 5-year lease, that is what it is. But because these are long-term assets for us, we value the flexible workspace as a barometer. If we're doing a good job of running ahead of pro forma, we're going to do a good job retaining the rest of the office tenants in the building. If we ever see that there's a lag or any skips, which we haven't seen yet, we're going to know this is time to think about what we're doing and really make sure that our product is positioned to be competitive, all of it across the portfolio.
Wayne, from more of a global approach to this question, I'm sure it comes up quite frequently. Anything you want to add to the question at hand?
I think a couple of things. One, I think Michael did a nice job describing. I think what's interesting is I would challenge anybody to see if they have a true understanding around what market is today. This is so dynamic right now. And what we are seeing is that leasing is down. There's no doubt about it. And we're seeing flight to quality, right? So the leasing that is being new leases that are actually being activated and executed is usually for smaller space at the highest level building, because there's availability everywhere. So there's a real concern around B and C class and how those buildings will be pivoted and where the investment will be made moving forward. So, what's interesting is it's a market that, again, is hugely dynamic. The other big piece, which is interesting, to Michael's point, we just opened up in Columbus here last week and 2 weeks ago, I guess. And it's great that we're ahead of the pro forma, which is frankly always the goal for sure. What's interesting about this business is this business continues to grow and the maturity of the business continues. So there's one element in the business, which is what we call residential revenue. And those are clients that rent space in the business. Like to Michael's point, and kudos to Michael, they designed a high density type of environment with 70 offices. It's exactly what you want to do, because what's interesting is clients want to walk in and they want to have the aspirational feel right away in the club space. Then you have a team that's right there ready to support the in-house client experience. And then behind the scenes, everything else is managed either via our technology, our apps, or a centralized organization. And the reason why I bring that up is you have residential revenue that continues to grow and mature, because as clients sign, they also retain. But there are 106 different revenue lines that we incorporate into every single location. And one I just want to call out, Nick, in the spirit of time, which is a great, which is important, is what we call virtual revenue, our virtual office revenue. Virtual office is actually continuing to grow. We saw an upsurge of virtual office revenue during the pandemic. We thought that would scale back. That actually continues to grow at the same rate. And what virtual office is virtual office is a solution we provide organizations and people that essentially gives them the address and all non-residential services within the location, and it's essentially almost pure profit for the partner, because it's space that's not being taken every single day by a client, but it's a powerful revenue stream, revenue source, and it's a powerful solution for clients, because it gives them all the Google search elements that they're looking for their business. It gives them the representative image. It gives them that address. It gives them mail forwarding, mail handling. This is a growing sector, and it's not a few percentage points. It actually usually represents 30% of the overall revenues, and that business traditionally continues forward. If you look at some of the most mature IWG locations, the virtual office business, those virtual office clients that sign in the first year many times stay for decades, right? Because it's a critical part of their business. So early stage ahead of the pro forma is great, but what's interesting about this business, and I really recommend everybody, I understand the capital outlay for sure, there's no doubt about it, but this business continues to grow and mature in profitability over time, right? And it really hits that level, kind of usually year 2, year 3, where you see that dedicated the return on investment, the ROI is achieved, and then from there, after that, it just continues to grow because a number of these revenue sources fall just even outside of the physical confines of the space.
Okay. Clinton said, Michael, have you had any unexpected experiences, good or bad, after the center opened? Now they have the benefit of hindsight. Are there any features you wish you would have added to the space?
That's a great question. Really, there haven't been any unexpected experiences after the center opened. The thing is that we stay so close to the project team that none of the surprises really came as surprises because we had a call every 2 weeks with the IWG team, with our architect, with our GC. And so, things that we had to address that are different than our normal build out were handled pretty incrementally. Like, for example, I'm used to when I'm done with a commercial lease, we sign it, all the IT, the kitchen setup, stuff like that is on the tenant side. We aggregated these services through IWG. So we were contracting with a couple of these vendors to get Wi-Fi and stuff like that set up. So that is different, and it's not necessarily something you would know going in if you've never done a space with IWG. But with a dedicated project manager, a team that's been doing this for a long time, none of those things came as post-opening surprises. Benefit of hindsight, my view is that you can never have enough visibility, especially for a downtown location. I think we did a good job with the signage. I think that I've been surprised by how much walk-in traffic there's been, just with the little sandwich board signage that we have outside that says, we just walk in today. We have someone who's a center manager to take all those calls. So I think that we are continuing to try to find more places because we have about 40,000 pedestrians a day at this crosswalk. And so we want to do more for visibility there. But within the center, like I said, about 70 offices in 10,000 square feet. It was pretty well optimized. I was surprised, my idea going in was, there would be a lot of conference or, spaces for desks for co-working. What's in the market right now are these private offices, especially private offices with light. And when you see the quote sheet and how these are selling, it's hard for me to say I would have done anything different at this point.
Love it. Wayne, I'll let you take this one. What is the size of your space when you sign up with IWG? I assume the question is, what is the typical size?
I love the question. Thanks, Virgil. So a couple things. One, it really can be as small as, let's say, 6,000 to 8,000 square feet. And the reason why I say that is because there are many times what we're seeing is a real need for boutique locations. I'll give you a perfect example. We have a great boutique location in Goose Island, Chicago. Wonderful little submarket. I'm sure Michael may know it. It's a perfect location in a great neighborhood that serves the local neighborhood, and is just frankly it's a great zip code. And that space is a little bit smaller, but it's a boutique, right? So it serves the need. And now I say 6,000 to 8,000 square feet because when you add in staffing, which is usually the biggest variable cost, you want to make sure that's when the pro forma starts to work, right? So, and we're actually working on some different models. We're working on a staffless model utilizing enhanced technology. The great thing is because we have 1,200 other locations, we can really cluster our staffing to help support multiple locations. Our staff, they're dedicated to a city. They work as a city, right? They're supported as a city. The locations across the city are all part of their focus and their effort versus just being one location. So 6 to 8,000 square feet is really where I think the model can become really sustainable and beneficial, but optimized. 10, 12,000, 15,000 square feet is a great size that I think supports the initial capital outlay and then also drives great return. That size, that 10 to 15,000 square feet, and then upwards of 20,000 square feet is really where you can see substantial returns.
Okay. Wayne, I'll let you take this one. What are some of the key marketing strategies that IWG team uses when entering new markets to educate and pitch the center to people living and working in the area?
Yeah, man, such a good question. I'm going to try to keep this really succinct because I want to make sure Michael has some good time to ask some questions as well. There is a significant marketing strategy that we deploy, and it really starts from day of signature, in which we start our social media focus and our PR focus in launching the new location on behalf of our partner, talking about how this new location in Columbus, the new Regus location on High Street in Columbus, is coming to your market, to your neighborhood. So we actually tackle this in a number of ways from day one with social media and PR. And then 90 days out, we launch across a number of different areas. So we launch with our SEM approach, also with digital prospecting, our SEO approach through organic search content. And then we also list this location, every location, on obviously our websites, our aggregator websites, and our portals. Now, why is that so important? Because IWG partners with 82% of the Fortune 500 companies globally. Those companies, they're not interested in searching for space. They're not going to go to look to see which co-working companies are in Columbus. They want to call up IWG and say, I have need for 50 developers. We want them to be in this geographic circle. What do you have to offer today? They need to be set up tomorrow. This is all about convenience. It's all about ubiquity. It's just like travel was 20 years ago to where it is today. Nobody's interested in looking at trying to ascertain the different options unless it's for their high-end vacation, right? So in this case, we launch it across each one of those portals, each one of those sites, because we have 10 million eyes on that site. And it's important to note, and this happens every day, we may have somebody in Dubai who needs space in Columbus, and they'll turn to their IWG team. They'll call up IWG Direct, or they'll turn to their salesperson, and they say, hey, what do you have today in Columbus? And that team has immediate access to inventory, to Michael's location, and actually can provision that space on the spot, and they'll move in the next day, right? So across the portals, across our websites, all critical, and then we list it on all brokerage sites, and then we launch a series. There are 10 campaigns and actions that we launch within the very local market, from local direct mail to electronic direct mail to neighborhood elements to local sponsorships within each one of those locations. Now, part of that is in partnership invested by the partner, and then part of that is an IWG invested action as well, and that takes place 90 days out, and that drives leads and inquiries that then convert to obviously revenue and occupancy.
Well, and I just want to add in, because I know this because we've talked about it, but just the pure organic reach of Regus or IWG brands, there's already a demand markets that don't even have a solution. So that's part of the benefit that obviously someone can have as part of being a partner.
I mean, a perfect example, unsophisticated, but look, critical. Every time we open up a location, we share that internally with our enterprise organization, with every member, with every team member, because all eyes help, right? Because once we do that, we actually send that latest location out to all of our clients. So that way they're aware of the new locations that are coming as well.
Okay, we currently have 7 more questions going, so let's see if we can hit these before we wrap. So, Michael, was there any part of the build out that was underestimated during construction?
Everything, we bid it with our GC. We work with him on a lot of projects. He really knows the buildings. So there wasn't any of that. The one thing that remains variable is that there's a furniture cost, right? So the model that we have that I think is working really well is that we thought about furniture up front. It was a great price on furniture. We've been furnishing other suites. This was a better price. I think working with Regus, you kind of see their buying power on a few things, including furniture and flooring. But again, because we've only furnished about a third of the space, as we start to get to capacity later in the year, we're going to kind of assess our inventory and order more furniture. So that's the only thing I would keep my eye on. There was nothing that was out of line or more expensive than we expected. Everything that we do with our GC is biddable and standard, and all the things that are outside of our scope, like the coffee machine or the Wi-Fi, our manager on the project got the bids for those, and everyone came in exactly their numbers for the bids.
Okay. Wayne, this is a big one, but what is the contract with IWG as in today's markets here in the UK? It's slowing down the demand on office space, as I have both flexible space and traditional office space. I'm considering converting some of these buildings to residential or hotels.
So traditional contract term is 10 years. It's really what we encourage. And if you take a look, it's just from a maturity perspective and the growth within workspace. The agreement that we traditionally undertake with a partner is 10 years, and of course it's certainly negotiable. We've run in situations where a partner may have a demo clause in a building at year 7, or frankly they just want an opportunity to say, look, 10 years is a long commitment. We understand the capital investment. We want to make sure it works. We're willing to obviously partner, and if there's a situation where the expected outcomes of revenue or occupancy are meeting the pro forma, look, we all understand. We want to make sure that this is the best for both partners and for IWG. So we can certainly negotiate around term length, but we traditionally look for a 10-year term length.
Okay. What is the typical build-out expense to a landlord per typical build-out, like Michael is describing in the center?
So great question, and certainly Michael can share his build-out costs. So this is interesting. It ranges depending on whether you're starting with shell or if you have space that's currently built out that just requires some additional upkeep, as well as some changes cosmetically, or to add a few other offices to really convert the space to a flexible workspace. So we've seen anywhere from $50, sometimes actually a little bit less than that, through to $150, $175. And that's from shell space overall. But what we've been really working towards, which I think is interesting, it's really taking advantage, is being opportunistic in the market. There's actually a tremendous amount of office space that's been beautifully built out that's currently on market that actually could work quite well for our partners and our clients looking to convert to flex space. So we've tried to build it out where we can make it as simple as possible, what we call our IWG starter kit. What's required what's expected from our clients, right? So when our clients walk into Michael's Regus, it should be no different than any other Regus globally. They know that when they fob in, they're able to access their office, they're able to access the meeting rooms, they're able to book their meeting rooms, they're able to access their printer through cloud-based solutions, they're able to pour their cappuccino. All of that experience should be consistent around the world, and certainly within North America. So we have what we call an IWG starter kit, which is really the mandatory elements from a service and equipment perspective that should be in every location. And then from there, after that, it's cosmetic. It's the signage, it's the club space, because frankly, people want the ability to work within 6 to 8 different work environments within the space, because their day is dynamic, right? So from there, it's investing in that furniture, and then of course also the flex enabling works, the build out. As you add offices, you have to shift your HVAC, et cetera. So build out expense can be as little as $35 to $50, and then upwards of, to Michael's, let Michael comment, certainly on $150, certainly to build out from shell. Sorry, Mike.
Yeah, and that again, we took a shell space, and it's kind of funny because now you reflect on it, and we had 3 spaces available in that 8 to 10 square foot, 10,000 square foot range when we started this project. The other 2 are still empty. This one's full. But when we look at the pricing, if we were to do kind of a conventional office build out for a typical tenant who has a lot more open space, fewer private offices, from the condition that we started in, we'd probably be looking at 70 to 80 a foot. Whereas with this, we're like probably around 120 a foot, all told, in part because we're fully furnishing the space, adding the kitchen, the IT infrastructure, all that stuff. But given how important the marginal dollars are in this business, again, it's great to have a base rent that pays for your OpEx, and but we're all really focused on the net, how much we're making, and again, having a pro forma that has us about a third of where we'd be if we found a taker for this space at the end of the first year, and maybe 2/3 above that. We got very comfortable, that if we're anywhere near our pro forma, we're going to be doing better than we would if we could find a good office tenant. And just to be frank, we're doing really well with 2,000 square foot spaces, but for that 8 to 10,000 square foot space, there's not a lot of takers in downtown Columbus. So that's kind of our point of reference on this space.
And I think it's what I appreciate is Michael's focus being progressive on this piece. You think about traditionally, you're gonna have to build out a base level, on behalf of your tenant, then provide TIs, plus your abated rent, plus fixturing period. In this case, the investment's coming from the partner, from the building owner, but in turn will drive a higher return.
Okay. Michael, I see you're a historic restoration expert from your website. Did some of your build out revenue from IWG conversion come from historic revitalization grants?
It's a good question. In this case, I wish it had. So the majority of the space is built out on the one newer vintage building on a block where we have a number of historic buildings, but that can be really potent with historic preservation, right? Because again, most of the incentives we see are on a percentage basis. And so if you have a use here, like a Regus or a Spaces, that is a higher investment and a higher cash flow, well, you're also getting more tax credits on a deal like that. So the next time looking at a historic redevelopment, those are projects where it's good to invest dollars because of the upside of these credits. And I think that almost all of what we did in this space would, as part of a historic renovation, be qualifying rehabilitation expenditures. So it's a great way to actually maybe more fully source up a project.
Rapid fire in our last 2 minutes. Let me try to get a few more up here. What is the partnership split with IWG? Is it on the turnover or a percentage of profits?
So, look, great question. I would definitely recommend spend some time with your partnership growth director on this piece, but very, very simply, what we look to do is we collect a management fee because we're managing the location on your behalf. We collect a management fee, and then from there, we recoup the center operating costs that are invested and paid for by IWG. Every other penny, every other dollar goes to the building owner. In the end, we understand the investment that's made, and that's made on behalf of the partner, the building owner. We want to make sure that outside of a management fee, which obviously is the cost for us from a management perspective, both locally as well as managing the business from a centralized perspective, management fee and center recoup, operating costs, every other dollar goes to the building owner.
Okay, let's try to get to 2 more. Can you discuss how soon a landlord can realize revenue from when an agreement is signed versus a conventional lease?
So I think it's really all determined on per location because there are different market rents. There are different underlying rents from a base and a gross perspective. But it's most pro formas, boy, we're probably seeing, a good NOI at year 2, year 3. Returns start at around 60% occupancy from in relationship to revenue. And we normally start to achieve that within the end of year one. And Michael, I don't know if you want to share anything else. Because obviously you did a lot of work on your performance in relationship to your building.
I think that I think in the final analysis, it's going to be pretty close to a conventional lease for us, because I think we managed to compress the build out timeline. And again, right now we're negotiating more extensive abatements. That's a big thing in the market. And, again, if we stretch our build out timeline 2 or 3 months working with a tenant who doesn't necessarily have experience with build outs, and then we have 6 months of abatement to burn off, well, we're already going to be in month 8, 9 of operation for our center. And again, since we really got the ratios right of sellable space to non-sellable space, I think that's when it's going to be performing probably at or above level of conventional lease with some room to run. So I actually think those two look very similar for our project.
Okay, I would love to close with this, Michael. For someone that's sitting on the sidelines, that's thinking about doing this, first, and second, what advice do you have for them for getting over their own fears of not moving forward so far?
I would say that if you're a developer and you work in this market, you've probably seen how much things have changed over the past several years. And this is a moment where I think there's a lot of pessimism about office. But the more you dig into the data about what employers want and what employees want, people do want to spend time in the office. They want to spend time with their colleagues. They don't want the commute, like Wayne said. There's a great phrase from that McKinsey report that he mentioned called, earn the commute. So, if you have space that's, maybe it still feels new, but you did it a decade ago, it's a little bit tired. This is the time to, go on the attack. Even if vacancy rates are higher, even if the market has shifted a little bit, this is the time to outcompete. And I think that when you partner with the world leader in this stuff, you partner with people who see how it works in all kinds of peer markets. They see it everywhere from the biggest cities to the smallest towns, and they understand the sort of local dimension of this. If you can work with their partnership team and really get to a point where you're comfortable with the pro forma, this is an opportunity to reinvest. We'd love to reinvest in all of our spaces, but in some cases, you're looking at the trade-off between doing something on spec and you're looking at doing something with a committed user who's operating thousands of centers. And the latter sounds like a better bet to me. And either one beats just waiting for something to happen. Again, when the market is shifting this dramatically, there's opportunity, and I think working with IWG has been a great way for us to realize that opportunity.
Love it. For Michael, Sean, and Wayne, I'm Nick Powles. Thanks for joining us on this conversation. Very active conversations in the comments section. Be sure to reach out to your IWG team member if you need more feedback. Everybody can be found on LinkedIn. Thanks for watching this discussion, everyone. Good luck on your journey.